If you invest in high dividend stocks, you're doing it wrong. Hey guys, Nick here, and I'm gonna tell you why financial advisors like myself think it's a terrible idea to be investing into high dividend stocks. But first, make sure you smash the like button to help grow the channel. First things first, what is a dividend? It's a cash payment you receive just for holding onto a stock. Hey Nick, here's $100. Sweet, thanks. Why are you giving me this money? Because you own 50 shares of Microsoft stock. It's your dividend. Yeah, that about sums it up. Dividends are just distributions of company earnings that are paid out to shareholders of stocks, index funds, mutual funds, ETFs, or REITs. Most dividends are paid at the end of each fiscal quarter, so you can expect about 4 dividend payouts per year for each dividend paying asset that you hold. You can estimate a stock's dividend by taking the dividend yield times the stock price. Now this is the annual dividend, so you have to divide it by 4 to determine each dividend payment amount. Not all stocks pay dividends. We'll touch on why later, but for those that do, dividends typically range between 1 to 4%, with 1 to 2% being the average. Though there are some outliers like AT&T that offers a dividend yield of 7.5%.
And of course, we have the Dividend Kings.
The Dividend Kings are a group of 31 stocks that have increased their dividends every year for at least 50 years. These include well-known companies like Procter & Gamble, Johnson & Johnson, and Coca-Cola. If you invest in the Dividend Kings, you can rest assured these companies won't be cutting their dividends anytime soon. Companies do have full discretion to cut their dividends or stop paying them out entirely whenever they want. Though in reality, it's very rare that companies do either. This is because cutting a dividend is seen as a last-ditch effort by a failing company to recoup some of its cash flow. It's a strong signal that the company has a weakening financial position, so this causes the stock price to drop dramatically. Because the jobs of the top people of the company live and die with stock price performance, they are heavily incentivized to keep dividends stable. But as I mentioned earlier, stocks aren't the only asset that pay dividends. Real estate investment trusts, or REITs, are publicly traded companies that own and operate real estate. If you know anything about real estate, you know that it tends to be cash flow heavy. Because of this heavy cash flow, REITs average much higher dividend yields than stocks at around 2 to 6%. A couple REIT ETFs you can look into are VNQ, IYR, and SCHH. I know, dividends are looking great so far, and I can see why. I myself was allured to high dividend investing a couple years ago. After all, who in their right mind would turn down an opportunity to generate a 100% passive and stable cash flow from their investments? Probably the same people who refuse to smash the like button. I mean, if I could just get 40K per year in dividend payments, I would never have to work again. Let's get to the 3 reasons why you shouldn't invest in dividends. But first, make sure you hit the subscribe button and notification bell to learn more about money every week. The first of many problems with high dividend yield investing is that it takes a lot of invested capital to get any significant amount of dividend. Let's say you want your dividend income to pay for your rent, so you pay 1K in rent per month or 12K per year. To generate 12K per year in dividends, even at a relatively high average dividend yield of 2.5%, you need 480K invested. To get to 40K in annual dividends received at a 2.5% dividend yield, how much money do you think you'd have to have invested? I'll give you 1 second here. $1.6 million. I mean, if you invested in an AT&T stock, you'd still need 530K invested. The second problem with dividend investing is, drum roll please, taxes. Dividends are actually subject to pretty favorable tax rates. Once you hold a stock for 60 days, its dividends generally become qualified. So if you earn under $40,400 from total income for the year, your dividend tax rate is 0%, but it's 15% for most people. So to actually receive $12,000 in dividends net of the 15% tax, you have to generate a total of $14,000 in dividends. But the bad news is REITs, those high dividend paying real estate companies, don't usually qualify for these favorable tax rates. So for most people, these will get taxed at 22 to 24%, but they could get taxed up to 37%. Plus whatever tax your home state imposes. This all goes to say that the major downside of investing into dividends is that it's impossible to avoid taxes on them unless they're paid to you in a retirement account. And if they're paid into your retirement account, it's basically pointless because you're not going to be able to access this money until you're in your 60s. If dividends are paid by assets held in your taxable brokerage account, it doesn't matter whether they're reinvested, held as cash, or withdrawn for personal use, they always get taxed, which is definitely not ideal when you're in the early stages of growing your portfolio. The third problem with dividend investing, stocks that pay dividends tend to have very low growth rates. In other words, you usually have to choose between high dividend yields or high stock price growth. Remember earlier in the video when I said that dividends are distributions of company earnings to its shareholders? Companies can do 2 things with their earnings. 1, pay them back out as dividends to their shareholders, or 2, reinvest them back into the company to help the company grow. If a company pays out a lion's share of its earnings as dividends and doesn't reinvest very much back into the company, it's probably not going to grow very fast. You remember our good friend AT&T who offers an absolutely monstrous dividend? Their stock price today is about $27. What do you think it was 26 years ago? $1, $5, $10? It was $28. Yeah, it's gone a little up and a little down since then, but that's 26 years of stagnation. Sure, you'd be getting your dividend payout every year, but after taxes, your return is only about 5 or 6% annually. So, how should you invest instead of focusing solely on dividends? The S&P 500 index, a collection of the largest 500 publicly traded companies in the United States, was at 561 points 26 years ago. What do you think it's at today? It's at 4,500 points today. That's a return of 700%. The best part about this gain, it's not taxed unless you sell your index fund. Index ETFs like VOO, IBV, and SUI let you invest in the S&P 500 index, which has had an average annual return of 10% since its inception in 1926. Buying and holding index ETFs like these, instead of focusing on dividend investing, lets you take advantage of tax-deferred growth, which is the same force that makes 401ks and IRAs so powerful. The best part about investing in the S&P 500, it still pays you dividends, though their average dividend yields are a little bit lower at 1.5%. Yeah, they're not AT&T dividend-wise, but you'll be able to harness the power of compound interest through capital appreciation while still receiving a decent dividend payout. With all that being said, it does still make sense for some people to focus on achieving high dividend yields. If you don't have a multi-million-dollar nest egg, and especially if you're just getting started with investing, focus on growth, not dividends. Don't let the appeal of dividends stunt the growth of your investment portfolio during its most critical year. Are you for or against dividend investing? Let me know in the comments. And make sure you subscribe and hit the post notification bell to learn more about money and investing every single week.